You're listening to the Retirement Architect, David Reyes.
You know, we're talking about kind of winning by not losing. And I call that zero's my hero in investing, meaning we give up no goals, great goalie, great defense. And that's the way we look at portfolios. Most of you won the game, meaning that you have enough assets to retire. Great article, actually in the Harvard Business Review, which I subscribe to. And if you don't, that's a great, highly intellectual magazine, obviously. Harvard Business Review, of course. People a lot smarter than me. But Dr. Robert C. Merton, he's a recipient of the 1997 Alfred Nobel Memorial Prize in Economics and Sciences. And he's also a finance professor at MIT Sloan School of Management. So pretty smart guy. And he says risk should be defined from an income perspective, and the risk-free assets should be deferred inflation-indexed annuities. This is a professor from MIT, a Nobel Prize winner. Risk should be defined, portfolio risk he's talking about, from an income perspective, and the risk-free assets, bonds he's talking about, which are not risk-free, should be deferred inflation-indexed annuities. You heard me right. Now, again, I'm a fiduciary. I look at different stocks, bonds, mutual funds. Again, we're agnostic to the investment. All I care about is the result. And I'll tell you, the biggest problem that I see with traditional portfolios is you fill out this questionnaire and it says, okay, what's your risk tolerance? Well, your risk tolerance has nothing to do with anything if you're going to retire. When you're near retirement, in retirement, you could have high risk tolerance. That doesn't mean that you should build a portfolio that owns more stocks or is higher risk. What we're trying to solve for, and we call begin with the end in mind, is we want to solve for how much money do we need to sustain lifestyle over your entire life of you and your spouse. And then how do we reverse engineer a portfolio that's going to make sure that we don't ever run out of money? That's it. So how do you know which assets that you need to invest in and how to build a portfolio until you can solve for the income, including inflation, taxes, healthcare costs, long-term care, all these issues? So if you don't have a plan like that, then you don't have a retirement plan, and most of you out there don't have that, unfortunately, because most advisors are really just asset gatherers. They're not planners, okay? We are a planning firm. We're a fiduciary. And so, again, talking about how to win by not losing, the number one way to do that is through guarantees. I wrote a paper a while back at wealthmanagement.com called Winning by Not Losing that was published a couple of months ago. And I talked about basically 3 different ways to protect portfolios for you. And I'm going to talk about 2 of them for sure today, one in depth, and depending upon the time we have, a second and then possibly a third. But it does take a little bit of time to get into this. And again, as a fiduciary, when we're talking about guarantees, and they're based upon the claims paying ability of the insurance company, I have to disclose always. But as a fiduciary, we only are going to deal with the best companies because that is our duty, and we're going to make sure you get the best potential rates of return, the lowest cost, and all of that. One of the biggest myths and the problems is that most of you like what annuities do. You just don't like what you've heard that they do or what they have. Most of you believe that they have really high fees. That's true with a lot of annuities. Not true with some really good ones that we like. Most of you believe that you buy an annuity and it goes to the insurance company and you have no liquidity back to you. Most of you believe that you're not going to earn a decent rate of return, so you shy away from them. Even though about a third of retirees have an annuity, it's still something that you have. But a lot of you, because I'm speaking to clients every day, are just misinformed, and I love to educate you and teach. And I probably spend 90% of my time teaching clients how investments work, how annuities work, how bonds work, which is a big one. If I could teach 2 classes would be bonds and annuities, because most of you just have misinformation on that. So bottom line is if I told you that we could put you into a investment that the fees were around 1%, similar to a mutual fund, your principal was protected, you could get market returns. We had one of our fixed annuities last year was up about 14%, okay? And, which is awesome. The market was up over 30, but so what? So you got nearly half the rate of return of the market, but you cannot lose money on the downside. On top of that, you have lifetime income for both you and your spouse, and your principal's protected, and you're invested in the market, okay? So there's very few of these types of investments, these types of annuities I like. There's probably, I can count on one hand the amount of companies that I really, really like that offer the rates of return that we can really make money, B, that have low fees, and C, that have really good lifetime income benefits for both you and your spouse. Because just like Dr. Robert Merton said from MIT, he said that risk should be defined from an income perspective, and the risk-free assets should be deferred inflation indexed annuities. Okay, and that's what we're talking about here, because that's one of your biggest risks is inflation. So, I spent about 7 years working with educators, and fortunately or unfortunately, they have what's called 403B. So if you're a teacher out there, you know what I'm talking about. And all of their options like 401ks were annuities. So for my first 7 years of my career, all I dealt with as annuities. Now, as an RI, registered investment advisory firm, and a fiduciary, we can do anything we want: stocks, bonds, mutual funds, and we look at them very precisely. Is it something that you need? I can tell you as a rule of thumb, if you have less than about $2 million, $3 million in a portfolio, you probably need at least about a third of your portfolio in some type of guaranteed income stream. And so if you're interested in a portfolio review, in a second opinion, please give me a call. And you can reach me at 877-406, call 877-406-2255. Again, 877-406-2255. And again, for the first 10 callers today, I'm going to give you a copy of a chapter of a book that I co-authored with Steve Forbes, presidential candidate and founder of Forbes magazine, called Successonomics. The book will be out in September, and I look forward to having my clients and potential prospective clients read that. But if you'd like to get a copy of the book, if you'd like a second opinion, you'd like to talk about how to win by not losing, you'd like to have a written retirement plan, we're the firm to do that for you. And again, our number is 877-406-CALL, 877-406-2255. Again, 877-406-2255. When we come back on the break here, I'm going to talk about a second option, but I'm also going to talk about why your broker is steering you the wrong direction when it comes to your asset allocations, and why 60-40 portfolios do not work for retirement. So I'll talk to you on the other side of the break. This is David Reyes, your retirement architect, on AM 760 KFMB.